Hello everyone, welcome to your own channel Daily Commodity. So today's topic is related to trading of a commodity, that is rubber. With the invention of the automobile in the late 1800s, rubber has become an essential material in the production of tire, floor mats and other automotive parts. In the recent year, global consumption of natural rubber exceeds 12.5 million tons, while the global synthetic rubber consumption approaches 15 million tons. The importance of rubber to so many industries ensure that it will remain a leading commodity in the global market. Uses of rubber spans across many industries including chemical, transport, agriculture and aerospace. So let me remind you, if you have not subscribed to our channel yet, please do subscribe to our channel and press the bell icon to get all the notifications and updates from Daily Commodity. In today's video, we are going to discuss about why should you trade in rubber, how to trade in rubber future, CFDs and ETF. Why should you trade in rubber? There are various reasons to trade in rubber. First, bet on automobile demand. The second is bet on crude oil prices. Third is inflation and weak US dollar hedge. Fourth is portfolio diversification. First, bet on automobile demand. The automobile market is the most critical industry for the rubber producer. Investing in commodity might be a way to bet on surging demand for the automobiles in emerging markets countries such as China and India. Similarly, the low interest rate environment in the United States and Europe should well for the automobile industry. Low rates means affordable access to credit market. Since the most buyer finance automobile purchases, rates play an important role in determining the demand. As long as the rate remains near historically low level, demand for the car and therefore the rubber should be strong. The second is bet on crude oil prices. Has the investment in natural rubber should perform well when crude oil prices are strong. As crude oil prices rise, synthetic rubber becomes less attractive to relative to natural rubber. The growing demand for the energy from emerging market is one reason crude oil prices might perform well. Similarly, economic growth in the developed Western countries remains strong. These factors, along with the relative dovish policy from central bank, could boost the crude oil prices. The third reason is inflation and weak US dollar hedge. Trading rubber is a way to bet on a weak US dollar and a higher inflation. Rubber is priced in US dollar, so the performance of the world's largest economy can impact its prices. The US Federal Reserve Bank has kept the interest rates low and the US dollar weak for many years. US central bankers are likely to continue this policy to support the consumers' borrowing and spending. This condition are likely to be very beneficial for the rubber prices. A weak US dollar could stoke inflation concern. Since there is limited supply of the rubber tree, the price of the commodity could likely benefit from the fear of the inflation. The last reason is portfolio diversification. Most traders have the vast majority of the asset in stocks and bonds. Traders Trading rubber provides a way to diversify and reduce the overall risk in the portfolio. How to trade rubber? Traders have a limited number of easy options for gaining the exposure to the rubber prices. That includes rubber future, rubber option, CFDs and ETF. How to trade in rubber future? The Tokyo Commodity Exchange and the Shanghai Future Exchange each have a future contract on the rubber. The Tokyo Commodity Exchange contract represents 5 metric tons of ripped smoke sheet of number 3 rubber, while the Shanghai Future Exchange contract settles into 10 tons of natural rubber. Futures are nothing but a derivative instrument through which the traders can make the leverage bet on the commodity prices. If the prices decline, the trader must deposit the additional margin in order to maintain their position in market. At the expiration, both contracts are physically settled by the delivery of the rubber. Trading future requires a high level of sophistication since the factors such as storage cost and interest rates affects the pricing. How to trade rubber ETF? ETF are nothing but exchange traded fund which are financial instruments which are traded as share on the exchange in the same way as stock does. There is no ETF that offers pure play exposure to the rubber prices. However, the Element Roger International Commodity Agriculture ETN holds many agricultural commodity including rubber in its portfolio. Shares of the rubber company. There are no public companies that are pure play investment in the rubber. Most rubber plantations are privately owned. How to invest in rubber CFD? One way to trade rubber is through the use of the contract for difference, which is again a derivative instrument, which CFD allows trader to speculate on the price of the rubber. The value of the CFD is the difference between the price of the rubber at the time of the purchase and its current price. If you like the video, please do like, comment, share. Thank you.